Deep into the red, the stock market goes. If we look at this heat map, we'll see a sea of red. Stocks are going down. So what is causing this? I want to cover what's causing this. I want to cover some advice that I'm giving myself and taking, and it's very valuable, and I don't think you want to miss it because it's something you might want to consider for yourself. I think it's just very important. But let's first look at my portfolio performance. This is something that I promise to show with every single video. A lot of YouTubers will show only the good side of things and never the bad. I show both. A lot of YouTubers will show fake things. Yes, that does happen, but this is real. This is a real portfolio, real money, real holdings, and that's something that I want to have this channel known for, which is honesty and transparency. So if you like that type of content, be sure to subscribe. And so we'll see here, I'm down 3%, which is almost $1,500 in the red. Just last video, I was only down $500. So definitely going deep into the red. And if you have any questions on my portfolio, just let me know. So what is going on with the market? Well, just recently, we did see the market start to go up in the green, and that's because the Fed signaled that it might not raise rates as high as it has been, so maybe 50 basis points instead of 75. But a few things have happened after they said that, which might cause the Fed to alter their plans. And the first thing is that on Friday, there were stronger than expected labor market numbers. In fact, the US added 263,000 jobs compared to what they estimated of 200,000. So that's 63,000 more jobs that were added last month. Now this obviously is going to have the Fed looking at it and saying we might need to raise it by another 75 basis points because what we're doing isn't touching this labor market and slowing down that hiring. So this is showing up in news articles, and you'll see here this article saying the labor market is still really strong, but that means a recession next year could hurt even more. It says the US added more payrolls than expected in November, marking another month of strong growth. That expansion, along with even higher wages, is good news for the workers still job switching, but the red hot labor market might mean more economic woes later on as the Fed Reserve steps in, which is what the market is considering right now. That is, the Fed's going to act harsher than what they were signaling. So not only is the labor market strong, but holiday shopping, consumer spending is proving to be strong as well. A record 197 million Americans shopped between Thanksgiving and Cyber Monday, which is up 10% from last year, and spending hit $9.5 billion. Amazon, in fact, reported its biggest Thanksgiving holiday weekend ever related to sales and number of items. It sold hundreds of millions of items. Amazon is a stock that I own, and so I'm happy to hear this, but there might be some points here later that is causing the stock to currently go down. So Walmart reported its online searches 5x'd from last year for Black Friday, so 5 times more, which we will probably see later on in their numbers that it created record sales and number of items sold just like Amazon. So holiday spend is expected to be above the historical average this year. And so the strong consumer spending is another reason why the Fed may alter its plans, and instead of raising it at a lower 50 basis points, let's say, they might keep with that 75 basis points that they've been doing. So this is causing the stock market to react. They don't like this because the stock market is forward looking and good investors are forward thinking. And so a few other things to consider is credit card debt is up 15% in quarter 3, which is the biggest year-over-year spike in 2 decades. That's not good, as well as savings are down. So Americans are stashing cash at the lowest rate since 2005. So those two things together, high credit card debt and low savings, I think it's going to create a cliff effect where spending will just fall off a cliff at some point, which is why Amazon stock might be going down because people are seeing that, hey, it's too strong and the credit card debt is high, the savings are low. That's going to eventually lead to a huge slowdown in spending. So with all this, what should you do? Here's the advice that I am taking. It's a page from Warren Buffett, and that is to buy businesses and not stocks. Too many people have a narrow view when they buy stocks. They only look at a few measurements or one part of the business, but you need to act as if you are buying the whole business. And what this does is this gives you a great perspective. You're going to be looking at that stock in a different way if you act like you're buying the whole company than you would normally just looking at a few metrics or a few parts of that business. So if you bought a business, would you be looking at the day-to-day price fluctuations in the stock market? No. Instead, you're going to be looking at what that company is doing, their moat, their future potential, what makes up their business as a whole. And instead of looking at just a few metrics, like I said, you need to think and behave like a business owner when you buy these stocks. Analyze the company like you are buying the entire company. And so an example of this that I think I've done a good job with is my stock and the company that I hold, that's Amazon. So Amazon, yes, their stock is currently going down, but I'm not worried about that because what I'm looking at is I'm looking at buying this as if I'm buying the whole company. So with Amazon, I'm buying a superior ad business. Yes, I think Amazon has the best ad business out there. When you're shopping on Amazon, you have all these other suggestions and marketing recommendations coming in and you're clicking on them, right? When I went on my vacation this summer, a lot of the items I bought, I can't tell you how many items I went through and reviews I read. You don't do that anywhere else. On Facebook, you see an ad, most likely you just scroll right past it. On Amazon, you click. So that's what I'm buying. When I bought Amazon, I'm buying a market leader in the e-commerce business. Yes, they're far and first, they're dominant, and that should help them. Should there be a downtrend in spending, maybe they'll stay at the top and just above other businesses. And I think that will really help them. And e-commerce is going to continue to grow, and it's proving to grow with Amazon in their recent numbers. When I bought Amazon, I'm buying a dominant, far and first cloud business, and that's Amazon Web Services. I think investors are sleeping on this part of the business, and they're going to look back and kick themselves for not considering it. Amazon Web Services, their estimated enterprise value is between $1.2 to $2 trillion. Right now, Amazon's market value is below $1 trillion. So just put that into perspective. I think Amazon Web Services will prove to be a huge part of Amazon's future growth, and I'm very bullish on that. When I bought Amazon, I'm buying a growing grocery business. They have Whole Foods, they have Amazon Go, and their recent earnings showed that this part is growing. When I'm buying Amazon, I'm buying a growing entertainment business. They have their Amazon Prime Video. They also have a partnership with the NFL. It's growing. Their Prime subscriptions are growing. This is a good part of their business. When I'm buying Amazon, I'm buying into a healthcare company. They recently just acquired a healthcare company, so this is yet to be kind of proven, but I like that they're getting into it, and I think Amazon has a lot of tools to make it successful. So when I'm buying into Amazon, I'm buying into all these things and so much more. I'm looking at it as if I'm buying this business as a whole. So know what you're buying and buy like you are buying the whole company. That's the advice that I'm taking, and I think it's great advice for you guys to consider yourself. It should prove to provide a very strong and profitable portfolio, I think, if you approach it in this way. So before I end this video, I just want to share this last point, and I share this every once in a while because I think it is so important. There are more powerful and longer expansion times in the stock market than recession times. So looking at this chart here, those big blue parts of this chart are the expansion times in the stock market where the returns were good. Now the little red times that make up a very small part of this chart are the recession bear market times where the stock market goes down. Right now I feel we're in the bear market time, and eventually we'll get to that expansion time. And so I think the thing to do now is to accumulate quality businesses. I have been saying this for a while. This is the accumulation time. Since February, since the stock market has gone down, probably through well into next year, I think we have an opportunity to accumulate stocks at good valuations, at good prices, and that's my plan, and I'm sticking to it. And so I'd like to hear if you agree with my advice, with my plan, and also what you will be doing. Do you buy stocks as if you're buying the whole business? Do you think that we are going into a deep recession next year because of what's happening now? We have high credit card debt, we have low savings, we have a strong labor market still that they're trying to bring down and slow down, consumer spending that they're trying to slow down. So let me know what you think. I'd love to hear your guys' opinion and feedback on this video. And with that said, I hope you guys have a great day, and we'll see you next time on Mark Arnold's Finance.